Howdy, everybody. Welcome to Liberty Call. I am Raymond Dahlman, excuse me, your humble host. Today is Wednesday, August 9th, 2023. Hope everybody's having a fantastical day out there. I got to spend a couple hours getting my emissions tested on my truck and then had to go over to the courthouse for the county and shell out like $700 for stickers for my license plates for my truck and my trailer. So not a good day. Very, very sad. So anyways, dealing with government morons is not my favorite thing to do. So anyways, like I said, I hope you're having a good day out there. If it's your first time watching Liberty Call, thank you very much. I'm glad you're here. If you could, give me some thumbs up, likes, shares, subscribes, follows, hit the notification button so you know when I go live, usually somewhere between 2 and 2:20. I'm in Mountain Time. So 4 to 4:20, depending upon what time zone you're in if you're on the East Coast. All right, well, let's go ahead and jump into the news for today. Looks like we got a little more red here domestically than the rest of the globe, but let's start out with the Dow Jones. It was down 0.54%, 190 points, closed at 35,123. The S&P 500 closed down 0.68%, closed at 4468. NASDAQ was down 1.17%, closed at 13,722. And if you listen to Ben Shapiro, he spent the whole podcast today railing about the economy. He thinks it's all falling apart, which I'm not going to disagree with him. Let's see here. The VIX was down 0.13%. It's currently holding at 1597. Canada was up 0.34%. Brazil was down 0.75%. And Mexico was up 1.07%. Over in Europe, Germany was up 0.49%. The UK up 0.8%. France up 0.72%. Netherlands up 0.42%, Spain up 0.57%, Italy up 1.31%, Switzerland up 0.22%, and Portugal up 0.4%. Russian exchanges both in the green today. The MOEX up 0.46%, the RTSI up 0.49%. And the overnights, the Nikkei in Japan was down 0.4%, Australia was up 0.37%, New Zealand down 0.16%. In China, the Shanghai was down 0.49%. Let's see, the Shenzhen component down 0.53%, China A50 down 0.07%, DJ Shanghai down 0.46%, Hang Seng up 0.21%, and the Taiwan weighted down 0.7% for the day. So kind of mixed, mostly, pretty good over in, looks like most of Europe and, but Asia, especially the Chinese markets, and then us, not quite so good. So all right, well, let's go ahead and dive into the market recap. S&P 500 slips as tech continues to bleed ahead of inflation data. On Wednesday, the S&P 500 experienced a decline driven by chip stocks and dragged down by the tech sector. Chip giants NVIDIA, Broadcom, and Qualcomm Incorporated led the downward trend, particularly after Daiwa Capital downgraded Qualcomm's rating, expressing concerns about weaker consumer demand, especially in China, and elevated inventory levels in the third quarter. The struggles extended to big tech players such as Apple, Microsoft, Alphabet, and Meta, which faced losses, contributing to the overall tech setback. This cautious approach from investors stems from the anticipation of Thursday's upcoming inflation data, which is expected to reveal ongoing deflationary pressures in the goods sector. The fall in used car prices is projected to drive this trend, with estimations suggesting a 0.19% increase in headline CPI for July and a 3.3% rise in the 12 months through July. This could further fuel the optimism that the Federal Reserve might delay any rate hikes for the remainder of the year. Again, you can wish it into existence. I don't think that the Fed's going to back down. I'll be completely shocked if they don't raise rates at the September meeting on the 19th and 20th. In terms of quarterly results, ride-sharing company Lyft Inc. encountered an over 8% drop in its shares due to concerns about margins, despite its second quarter results surpassing expectations. Some Wall Street analysts expressed positivity about Lyft's performance, highlighting improvements in driver supply, pricing, and rebounding rides growth. Similarly, Rivian Automotive saw its shares decline by over 7%, despite raising its annual production guidance and reporting a narrower loss in the second quarter. In a significant move, Disney's ESPN partner partnered with sports betting firm Penn Entertainment to establish ESPN Bet, a sports betting business, in a $2 billion deal. As a result of the partnership, Penn Entertainment's shares rose by more than 7%, while Disney experienced a 1% increase. The market's cautious behavior reflecting the prevailing uncertainty regarding chip stocks, tech performance, and impending inflation data. Investors' attention was drawn to the potential impacts of factors such as a weaker consumer demand, inventory levels, and deflationary pressures. Despite pockets of positive quarterly results, market sentiment remained influenced by these broader concerns and the potential implications for the Federal Reserve's policy decisions. All right, so not the greatest. People are hoping that the Fed's not going to raise rates again next month. But again, this stuff is sticky, and things are still warm. And we're going to talk about next oil prices. They are going back up, which is not going to help inflation any. This next article: oil prices at 2023 high, confounding 3-year peak in U.S. output. All right. The recent weekly report from the U.S. Energy Information Agency, the EIA, has provided a surprising twist to the bullish narrative of Saudi production cuts. The report unveiled a 3-year peak in U.S. oil output, reaching 12.6 million barrels per day during the week ending August 4th. Yeah, but we go through 20 million barrels a day. So that's still an 8 million or 7.5 million shortfall that we have to buy from overseas. We should drill more here. Let's see here. This marks a notable increase in the agency's previous estimate of 12.2 million barrels per day and the highest level since the record 13.1 million barrels per day before the pandemic in March of 20. This upward revision by the EIA holds significance, especially when considered alongside the significant decline in U.S. oil rigs observed this year. Despite the drop in rig counts, the EIA updated production estimates indicate a fundamental shift in U.S. oil supply dynamics. However, the market reaction seemed to downplay this shift. Investors, particularly those who had been optimistic about Saudi oil output cuts, pushed crude oil prices to their highest closing levels in 9 months. U.S. West Texas Intermediate, or WTI, crude settled at $84.40 a barrel, while Brent settled at $87.55 a barrel. These gains were driven by market focus on Saudi production commitments rather than the revised U.S. production figures. Notably, the EIA's report indicated a substantial build in U.S. crude stockpiles for the reported week, which contrasts with the previous week's record drawdown. Crude stockpiles increased by 5.851 million barrels, attributed partially to a decline in U.S. crude exports, which fell to 2.36 million barrels from the prior week's 5.283 million barrels. Gasoline inventories experienced a drawdown of 2.661 million barrels, marking the first significant consumption in 5 weeks. The decline in distillate stockpiles also stood out, with the weekly draw of 1.706 million barrels, representing the largest drop since May. These trends highlight the complex interplay of factors impacting oil and fuel markets. The EIA's report underscores the dynamic nature of the energy markets, where multiple variables interact to shape supply, demand, and price trends. While Saudi production cuts remain an influential factor, the unexpected surge in U.S. oil output suggests that market participants need to consider a broader range of factors in assessing future trends. Well, we could get back up to the 700 plus oil rigs that we had online prior to March of 2020. Probably would be helping things out right now, but they're not. So, all right, last up, I got an article here from Mises Wire. It's titled Credit Crunch, the money supply has shrunk for 8 months in a row, written by Ryan McMacken. All right, the U.S. money supply growth continues to plunge, maintaining its negative trajectory since November of 22. This trend has persisted despite hitting negative territory for the first time in 28 years in November. Throughout the past 2 years, the money supply has experienced a drastic contraction from its previous unprecedented highs. Starting in April of 21, money supply growth has decelerated rapidly, and the downward trend has persisted, leading to 6 consecutive months of year-over-year contraction. This negative growth trend, standing at a negative 12.4% in June of 23, is slightly higher than May's negative 13.1, but significantly lower than June's of 22's 5.7%. This represents the largest contraction in money supply since the Great Depression. Prior to this year, the money supply had not fallen by more than 6% year over year in any month in the last 60 years. The money supply's measurement used here, the true or Rothbard-Salerno money supply measure, the TMS, was developed by Murray Rothbard and Joseph Salerno. Unlike M2, the TMS includes treasury deposits at the Fed and excludes short-time deposits and retail money funds. The recent decline in M2 growth rates closely mirrors the decline in TMS growth rates, although TMS has fallen more rapidly. Despite the negative money supply trend, crude oil prices are influenced by Saudi production cuts rather than this economic metric. The Mises Institute's TMS growth rates, coupled with more subdued M2 growth rate, emphasize the significant and rapid decline in the money supply. Historically, money supply growth patterns have served as indicators of economic activity and potential recessions. Economic booms typically coincide with fast money supply growth as banks increase lending. In contrast, slow money growth frequently precedes economic recessions. The current downturn in money supply contradicts the norm of expansion and underscores the significant drop in money supply growth. The shrinking money supply is notable since it's a rare occurrence. Since April of 22, the money supply has fallen by 2.8 trillion or 15%, proportionally the largest decline since the Great Depression. Although this decline has not yet significantly affected the labor market, the overall economic weakening is evident in various indicators such as manufacturing, lending indicators, and the yield curve pointing towards recession. The Federal Reserve's cautious approach to monetary policy has resulted in a reduction in money creation. With short-term interest rates rising, banks are more cautious in issuing loans, impacting companies' financial health and causing layoffs. While the monetary slowdown effects are felt throughout various sectors, the dire economic situation could be alleviated by halting new money injections, focusing on saving and investment rather than artificial market stimulation. And again, don't get this twisted, because the Federal Reserve and our own government are the reasons for this problem. They printed $5 trillion in the summer of 2020 to help us with the whole COVID crap. And, look where we are now. I would have much rather gone through because we were headed into a recession, market downturn, whatever it was, at the beginning of, when 2020 started. And all they did was, print a bunch of money and paper over the economy, and everything felt fine for a year or two. And then, boom, here we are now with massive inflation. The national debt is up 33 trillion at this point. It's never getting paid off. So, that's where we are. So if you're mad at anyone, be mad at the Federal Reserve, be mad at your congressman and your senator and the president. And that goes for Trump too. He did the same. He was in office at the time when all this madness started. So I blame them all. All right. Well, if you need to get your financial health back in order, feel free to give me a call. You can go to dsafinancialgroup.com. All my contact information is there. Otherwise, that's all I had for today. And I hope you have a wonderful evening, and I'll talk to you next time. Adios.